The stock market reacts to one of the largest banks blowing up in something we have not seen since 2008. SIVB essentially went out of business within 24 hours. You can see just how fast this happened. On March 8th, the bank announced this loss of $1.8 billion, and then within 24 hours, they withdrew $42 billion in deposits. We'll state what this means and what it does for banks going forward. We'll go over who will be next on the chopping block and two key indicators to watch. Address the fallout of this, what exactly is happening to crypto, why crypto's coming in pretty hard, why the dollar rally has fizzled, is now a good time to buy bonds, while the 2-year treasury has dropped 50 basis points in yield in 2 days, as well as who's going to benefit. The S&P sold down. We're going to use the SPY here for a moment. It's very clear that you have the little indicator right here. You can see your break and you can see your downward move. Now, all of this was not predicated upon non-farm payrolls. And I think that's a really important distinction that we need to make. What we were looking at before is no longer what's going to wear on us. We went over this previously in a previous video where we were looking at the spread. In other words, the differential between the 10-year and the 2-year, and the spread from November 1976 all the way down to about 2% here. But it took 3 years for the spread to get a 2.5% differential. In our example that we're living through right now, it's taken 18 months. That means that the pressure that you saw in the S&L banks back here is now coming in over here. But it's coming in at a much faster rate than before. SI problem was not crazy loans or anything along those lines. It was very simply just owning treasury bonds. In deep diving into this, what you're seeing is that they owned right in here was their average price on the 10-year. Now, if you take a look at it from that perspective, what you have to realize is that if you're long here, it was roughly 187 is where SIVB owned the majority of its 10-year. Of course, these banks lever, they all lever. But the issue that you have to kind of wrap your head around, and this was done very eloquently by someone else, I'll try to figure out and post who that was. But essentially the way that this works is, if you take a look at where you're at, so here's where your peak was on the 10-year. And you look at that peak and you can see 2.5%. What you need to do to understand that move is to take the 2.5% differential and then you times it by that duration, so 10-year duration. So in other words, what you're doing here is you're taking 2.5% times 10-year duration. That multiplication gets you a number. We should all be able to figure out that that number is around 25%. That means that the loss that they're taking on these bonds is 25%. Now, it's not a problem as long as they have the cash flow to meet the obligations of the loans that are outstanding. But when you borrowed money here, and depositors are looking at what they can get by buying a treasury bond, they're going to go and buy a treasury, or they're going to go find someone else that doesn't have 1.87% on their 10-year bonds so that they can lend more money. Now, while this is important, if you're getting 1 or 2%, and then you can go out there and say, wait a minute, for 2 years, I can get 4.6% on a 2-year treasury, you're going to start reallocating capital. You can even go out there on a 6-month treasury right now and get 5.12%. So this was only a matter of time before we started to see some kind of cracks. Now, the problem with this and what's happening with SIVB and why this run on the bank is so scary is because we've been told over and over again by the Fed that everything's fine. We had Bostic last week saying, it looks like just 25 basis points from now on. And no one is talking about the underlying issue here. You have the fastest move down to inverted interest rates that you've ever had in the history of charting them. It hasn't existed before. And this is a massive, massive problem. We were all under the impression, myself included, that they were stress testing the banks, talking to the banks, making sure that things were good. Now, it could be a case of that the stress tests that they have don't work properly. It could be a case that they were just lied to. I think that there's going to be a lot more that goes into this. But the bottom line is now this becomes a problem. This is not going to go away. What you're seeing is a bank line. Now, when we start seeing bank lines, people are going to panic. No one's going to want to be standing outside of their bank trying to get their deposits, their payroll. It's not a good look, and that's not where you want to be. And this is a massive problem. Now, before we continue and go over some criteria, I think it's important to understand that this can spread. This is the USDC reserve report showing where the USDC, meaning the digital currency, is actually located at. And you can see down here that they circle in red. cash held at U.S. regulators, Financials Bank of New York, Citizens, Customer Bank, New York Community Bank, Signature Bank, Silicon Valley Bank, Silvergate Bank. Okay, so now 2 of these banks are under. Now we have Signature that's on the block right now. Citizens and Customer Bank and Bank of New York seem to be hanging in there, but Signature seems to be having some issues. Now, what does this mean? In front of us is the USDC, and this is by Gemini, and you can see the US dollar. This is USDC in relation to the dollar. This is supposed to be at $1. That is where this is supposed to sit at. It is supposed to be stable. You can see the move down all the way to 81 cents, or where it lost almost 20% of its value. And the reason for this is because what USDC is doing is it's taking all the capital that people are going to buy the coins with and putting it into a bank. Okay, so that is what they're doing with the money. So in other words, the money comes into USDC and they put the reserves of this into the bank. Well, the bank's not insured, then this USDC is no more stable than having a deposit in a bank. In other words, the mask is starting to come off here that all this crypto is really just tied to our banking system. And that's led to some really big moves down here. In Bitcoin, we can see how that's acting on the news. I'm not sure how I feel about this move down. I'm not so sure how I feel about the USDC move down. If you have your assets at SIVB right now, you have a problem. Okay, that's pretty obvious, right? So I think we have to go on the problem that USDC may have an issue. And if you're in there on a stable coin and you're being backed, or you're fluctuating based upon that and you're watching it happen, you're going to get out of everything. So that's going to lead to some pressure here. Now, when you have runs on asset classes, it can lead to opportunities in certain names. Sometimes you have to wait, let them sort themselves out. Now, the source of what I'm showing you is the S&P Global Market Intelligence. And what this is deposits less than 250,000 as a percentage of total deposits. I'm going to say it again. Deposits less than 250K as a percentage of total deposits. What does this mean? Well, FDIC is insured up to 250, which is kind of insane. It should be substantially higher, and we'll probably see some regulation on that. But what we're looking for here is we're going to go, okay, well, here's fourth quarter, and we can see where these banks are. All right, so we're seeing some of these banks that really have it together, don't they? Okay, and then we're going to go look at some of these other banks and go, do they have it together? Well, if we start looking at fourth quarter 2022, we see Bank of New York Mellon is down here. We can see SIVB is down here. NTRS down here, STT. So in other words, what this is showing is not the financial acumen of the account, right? Of the bank rather, and how they're diversifying, but it shows who is the most vulnerable if they're not diversifying the way that they're supposed to. I would argue that anything under single digits is a huge concern right now. That would be a concern of mine. Anything under single digits would be a concern of mine right now. So you look at this and you go, okay, so now that deposits are here and they're under 2.3, Bank of New York 2.7, 4.0, but we don't know Bank of New York, and we don't know how much risk Bank of New York has, for example, right? We don't know yet. We're going to get to that in a moment. JP Morgan, you can go over here and go, well, 32% of all their deposits, 32% of all their deposits are insured. Well, where do you think people are going to want to put their money? Are you going to want to put your money in a bank that you know is not going to have a problem? Or are you going to want to put your money in a bank that you think would have a problem, right? Based upon having deposits, if they have a run on it, that then their money's going to be locked for a longer period of time. This is how run on the banks start. But also we could look at something like regional bank and go, all right, RF, and then we look at 52.5%. That's great. The issue is we don't know yet what's in RFG and what they're doing. We don't know if they're in the same situation as an SVB, so we don't know enough, but we can see who's protected and who's not. You might want to screenshot this. So now we know what banks are most at risk, and if people start understanding that, they're probably going to move from there. But what we really should focus on is this is top 100 institutions by asset size. So this is the second criteria that I would suggest that you consider. And when you start looking at this, what you're going to realize is that you have the total securities outstanding, the equity capital, and then this is this is referred to something else, but think about this as losses on the books that you have not taken. Okay, in other words, you don't have to take the losses because essentially what you're doing, you're still making the deposits. You're still making the payments rather. And what you're going to see here is you're going to get a percentage over it. And this percentage is going to show you the relative exposure. This is why you're seeing Schwab come in so hard. You can see that there was literally no quarter given, no mercy whatsoever. It was just straight selling. And even into the weekend, we did not see any kind of bounce on Schwab. And the reason is because of that graph that I just showed you. So even though they have, let's say most of their deposits are insured, let's say they're on the high end of the first graph, it doesn't matter if they start having a run anyway, because then they're still in a position where they're not going to be able to meet their obligations. And that's the concern. So Schwab's going to have to issue some kind of statement, in my opinion, on exactly what's going on there. Now, if you continue to look at your deposit list and you go through these names and you go, okay, well, here's STT and they have 4.3%, okay? Deposits are insured. And then we look at the action in STT's chart and we can see the breakdown. See, we're not rallying, there's no real bounce there. Then we look at the top 100 institution chart and look at the percentage. And you go to STT and you see that they have this fairly decent high percentage loss. Is it up here where it's Silicon Valley Bank and Charles Schwab? No. But what this is telling you is that if STT starts seeing a run on the bank or has a problem, 90% of their deposits are not insured. So if you start going through this list, you can see why First Republic and why he's fielding phone calls all last week. You can see why Bank America didn't bounce. You can see why people are going to look at Bank of Hawaii, right? All of this starts to become pretty clear. This is another shot you might want to screenshot. And I think that there's something really very important here that we're going to go over in a moment. JP Morgan on this list, okay? Top 100 institutions by asset size. Number one, JP Morgan. You look what's going on here. You look at their 12% loss number and you look at their deposits, 32%. What's the safest bank right now? So I'm going to tell you what every corporation's doing this weekend if they haven't done it already. They're going to start withdrawing money from regional banks and they're going to start putting money into JP Morgan because it's going to be the safest place for them to put their money right now. So they're going to start coming out of places like FRC. They're going to start coming out of places like Bank of Hawaii. Okay, you're not going to see massive amounts of people come out to support, quote, their bank. People hate banks to begin with. So in other words, what you're going to see is you're going to see a run on these banks to some extent. Now, how those banks are tested and what kind of stress they go under and if they're able to sustain, I have no idea. I don't have a clue to that. I can only tell you what I see technically, and those two data points that I just gave you are pretty much all we're going to have. None of these companies, such as Bank of Hawaii, are going to open up their books to us to show us, their exposure to the 10-year or their average yield. They're just not going to do it. But there should be a check and balance system, note the word should, that are identifying this. For us right now, JP Morgan seems like the best case. Again, it's going to be guilt by association. They're going to sell everything down. But when the reality starts settling in on what I just showed you, and when people start connecting the dots this weekend, I would expect JP Morgan to do quite well through this as it sorts itself out. It's going to take time. This is not going to be fast. I think SBNY is extremely vulnerable here. Very vulnerable here. I do have a short position in it, but the way that you're set up here technically, if we break, this can go substantially lower. Make sure you subscribe to the channel. I got asked a lot to show some live trades, and I'm going to put a video together that actually shows some of the live trades that I personally do. And I'm going to actually tie the live streaming that I do in the private Alpha Chasers community into it as well. Then if you look out there and you think, well, there might be more carnage, this is the one to look at. It's the simplest trade. This bear 3X, you saw it start to break out down here, started hitting my radar. But the question is, what do you do with it now? I think you need to flip that 200 and we'll see what happens on Monday. I'd be shocked the IC does not come out with some kind of statement if we don't hear from Powell or Yellen on this matter. The amount of lack of any kind of statement so far is very interesting. Now, JP Morgan, again, you can just see how we're holding in here. We want to focus on that. One thing that's very interesting that we're not hearing anything about whatsoever is Goldman. We're not seeing that rush into Goldman as we normally see. Matter of fact, we're seeing it break its 200-day moving average. The two that I was looking at last week when this started to happen was Goldman and JP Morgan. Okay, I am legging into JP Morgan already, but I could be early. I'm usually early. So you see these levels right in here? I don't know how this is going to hold that level. Any technician is going to look at this and want to get out. I don't know if there's something there on Goldman's books that's an issue. And quite frankly, any of the charts that we look at, I don't see enough data to substantiate this, and they're certainly not going to open up their books to me. So I'd watch Goldman here. It looks vulnerable. Now you look at Schwab, and based upon those charts, you can see why this is happening. It's very difficult to tell somebody to short a stock that's down the way that this is. What you'd want to see is some kind of rally and then put the short on. Is Schwab going to have real issues? That I don't know. But with the loss that I saw, I would imagine that their phone is ringing off the hook. And this becomes a self-fulfilling prophecy, right? Even names like Citigroup are going to hold up on this because of the way that their deposits are structured, and they're not highly levered like some of the other banks. And you can see how they're holding in here, and how institutions, this is really the last spot for the bulls to hold, is the 200-day moving average. It held. Now, if you go out there and look at the entire sector, well, that's pretty ugly. But it's a doji. Now, maybe that doji holds, maybe it doesn't. If you are looking at this and it doesn't matter what it is, but if you were looking at this and just forget that this is financials, you would not expect that to just hold here. You'd want to see some confirmation, right? And that's what I would suggest before you're really thinking about putting a lot of money to work. You will really want to see some kind of confirmation that this is behind us. Because you could just come in on a Tuesday or Wednesday now and just like we showed that line, and there's another bank with an issue. And that's what you really want to avoid. You look at this on the weekly, okay, and you've cracked. I mean, that's pretty clear, that crack. FRC, this is really very difficult, but I would have it on my radar for trading. I mean, you have this enormous range of almost 45 points, right, between the gaps and everything else. But you're going to want to watch this, okay? You're going to really want to watch how that plays itself out. The USDC, you want to see this get back to $1. If it cannot get back to $1, I would avoid crypto until it does, because the underlying pinnings of where people are, quote, putting their money when they're not buying crypto is not secure. You're down 4% in your what's the equivalent of what's supposed to be a money market, and that's a problem. So these are core issues that we're going to have to address. Now, what I think one of the major benefits here is, if I was a long-term investor, I'd be out buying the 10-year right now, because this is probably the peak. There's no way in the world they're going to come out and raise 50 basis points right now. If they do, you're going to create even more of those red losses we showed earlier. And no one's going to want to tolerate that right now. So, and this is what you're seeing. You're seeing them understand, like, okay, you wanted to see how far you could go by raising rates faster than any time in history. Okay, congratulations, you just found out. So that's the issue here. That's why you're seeing this rally. I'd be looking at 6-month treasuries, 2-year treasuries. If you were looking to put capital to work and you're willing to wait a year or two, it's up to you what you want to do here. But if you want to understand how the market's going to move, and certainly this is not investment advice, this is just me pointing at charts. But if you start looking at this, it's kind of giving you that indication that we're at a top. Now, if we're at a top, all those red losses that I just showed, they're all going to start mitigating. And that's because as bond yields drop, bond prices go up. We can look at these technically. We can look at the Qs. We can look at the S&P. The bottom line is, if we lose another bank, or the Fed comes out and says, we're not going to raise interest rates, we're going to put a pause on this for a couple months, the next 2 meetings, the next meeting, just until we figure out what's going on. They're looking at technicals right now is great. It's not paramount, because the technicals are going to change predicated upon what comes out as we sort through what is happening. Okay, so I do want to watch the Qs. I do want to see where I'm at. It is not realistic to think that the NASDAQ is going to go higher while you're watching stocks or sectors like biotech implode, because they're wondering how much cash biotech companies have at Silicon Valley Bank. Note, it's a lot. These are the kinds of things we have to watch. Okay, now, if you go out there and look at the SOX, which really is not breaking, but one of the things I pointed out here in the newsletter, if you don't get the newsletter, make sure that you do. It is free, and there's a link in description. Now you go here and take a look. See how you're curling down? I like semis. I love NVIDIA, but that's not making me feel warm and fuzzy about owning NVIDIA here. I don't feel really great about that, but I'm holding for now. Should we see another bank, I think you start to see more pressure on the winners. I think people are just saying, I need to sit on the sidelines. I remember 2008. I don't want to go through that again. And I don't think we're in the same situation as in 2008, 2009. I want to clarify that, because in that period of time, banks were nowhere near, the large banks were nowhere near that strength. We're seeing this on the regional side, and this could be a problem for regional banks, very similar to what happened in 1980 with savings and loans, but it's not going to be on the conglomerates because they've been stress tested. Will there be weakness in one or two? Yes. For now, just continue to monitor what's going on. Look at your key levels. Again, we can go out here and I can show you things like this trend line, right? And we can all go, ooh, we broke. And then we're right here. And I'm not trying to make light of it. What I'm trying to do is just say, I don't know what's going to happen. What happens if JP Morgan comes out and acquires SIVB over the weekend? There's so many variables out there right now that we just don't know. We have to be aware of this. We have to be cognizant. We have to trade what's going on. That we have to do. But we also have to be aware that there is a lot of risk out there that we didn't have 72 hours ago. So I hope this was helpful. If it was, please share it. It's really important for me to get this message out there for people to actually understand what's going on in the market. Everything I went over today is fairly actionable. Any questions, reach out. Any comments how I can make these videos better. The reason I'm doing live trades and showing some of my own live trades is because of your comments. So the more you comment and let me know what type of content you want to see, that's what I'm going to put out. If you found this helpful, please share it. Please like it. The sharing's most important to me, guys, because I'm just trying to get in front of people so they just don't get hit with that sledgehammer. Have a great day, everybody.